With inflation wreaking disaster on our wallets, it's crucial to understand how these adjustments can affect our taxes. So, let's break it down step by step. Let's start. Tax brackets act like thresholds for your income, determining how much of your hard-earned money goes to the government. But here's the twist, it's not a one-size-fits-all scenario. Your tax bracket depends on your filing status, whether you're single, married, or head of household. And within each status, different income levels trigger higher tax rates. So if you're wondering why your neighbor might pay a different rate than you, it's all about where you fall in those brackets. Now, let's get down to the specifics. We'll navigate through these tax brackets together and make sense of how they impact your wallet. Alright, let's break down the tax brackets for single filers in the US. So, if you're earning between $0 and $11,600, you're taxed at a 10% federal tax rate. Moving up, the 12% tax bracket covers income from $11,601 to $47,115. Now, brace yourself for the 22% tax bracket, hitting incomes between $47,116 and $100,525. This is where the majority of taxpayers fall, with median incomes around $70,000. But wait, there's more. The 24% tax bracket kicks in for income between $1,526 and $191,900. Any income above $191,900 gets pushed into the next bracket, taxed at 32%. And if you're raking in over $243,700, get ready for the 35% tax rate, reserved for the top 1% earners. Finally, the highest tax bracket hits income over $539,500, taxed at a hefty 37%. Now let me ask you this, do you know which tax bracket you fall into? Understanding these brackets is key to managing your finances effectively. So, whether you're just starting out or climbing the income ladder, you can check out the service in the description. They can help you in tax filing service. Next, we have a breakdown of the tax brackets for married couples filing jointly. If you're filing jointly and your income ranges from $0 to $23,200, you're taxed at a 10% rate. Now, that's just a starting point. As your income climbs, so does your tax rates. Moving on to the second tax bracket, which starts at $23,201 and goes up to $94,500. In this bracket, you'll be taxed at 12%. Now let me ask you this, do you know which tax bracket you fall into as a married couple? Understanding these brackets is crucial for managing your finances effectively. As your income exceeds $94,500 and reaches $250,000, get ready for the 22% tax bracket. And if your income surpasses $250,000 and hits $383,900, you'll be in the 24% tax bracket. But hold on, it doesn't stop there. For married couples making over $383,900 and up to $487,000, the tax rate jumps to 32%. Now here's where it gets interesting. The 32% tax bracket ends at $487,000 for married couples, whereas for single filers, it ends at $243,000. Quite a difference, isn't it? Now, let's delve into the tax brackets for those filing as head of household. It's crucial to understand that not every taxpayer qualifies for this status. If you're legally married, filing as a head of household isn't an option. You essentially have two choices, married filing separately or married filing jointly. However, if you're single and supporting qualified dependents, you can claim the head of the household deduction, leading to greater tax benefits. Let's break down the head of household tax brackets. If your income ranges from $0 to $16,550, you'll be taxed at a 10% rate. But what if you're earning more? If your income falls between $16,551 and $63,800, you'll face a 12% tax rate. Now let's talk about higher incomes. Say you're making over $62,800, you'll find yourself in the 22% tax bracket, with your income subject to higher taxation. But wait, there's more. If you're earning over $100,000, you'll enter the 24% tax bracket, extending up to $191,900. Now let's get to the upper tax brackets. The 32% tax bracket awaits those earning over $191,900, while the 35% bracket kicks in beyond $243,700. And finally, any income exceeding $437,150 lands you in the 37% tax bracket. Understanding these tax brackets is essential for maximizing your tax benefits. Now we will explore additional changes to the tax code, particularly focusing on the standard deduction. Understanding how the United States employs a graduated tax rate system is key. This means the tax rate of a specific bracket applies only to the income within that bracket, and as income rises, tax rates increase accordingly. But you might wonder, will the IRS continue to adjust tax brackets for inflation? The answer is a likely yes. As long as inflation persists, expect annual adjustments to keep pace with rising living costs. For instance, a single filer making $100,000 could see their taxable income drop to $85,500 after applying the standard deduction, a notable reduction. So what does this mean for you? Well, inflation adjustments tend to make tax brackets more favorable, requiring higher incomes to reach higher tax rates. This results in potentially owing less in taxes compared to previous years with the same income. For example, earning $100,000 in 2023 would place you in the 24% tax bracket, whereas in 2024, the same income falls into the 22% bracket due to inflation adjustments. This demonstrates how inflation-adjusted tax brackets can lead to decreased tax liabilities. But why does the IRS make these adjustments? It's about fairness. Recognizing the financial strain inflation imposes on individuals, the IRS aims to maintain equitable taxation by periodically adjusting brackets to reflect changing economic conditions. The reason behind the IRS making inflation adjustments boils down to keeping up with the increasing cost of living. When prices go up due to inflation, the value of our money decreases, making it harder for people to afford the same things they used to. This isn't just about groceries or gas, it affects everything we buy and how far our paychecks stretch. By linking tax brackets to inflation, the IRS ensures that taxpayers aren't accidentally pushed into higher tax brackets just because their salaries rise to keep pace with inflation. This might seem unfair. Imagine getting a raise only to find out you owe more taxes because of it. Indexing tax brackets to inflation helps to level the playing field. It means that even if your salary increases to keep up with rising costs of living, you won't necessarily end up paying more taxes as a result. This system also helps to maintain fairness in the tax system. It ensures that those who earn more still pay a higher percentage of their income in taxes, while those with lower incomes aren't unfairly burdened by rising costs. Without these adjustments, inflation could gradually push more people into higher tax brackets over time, even if their real purchasing power hasn't increased. That wouldn't be fair. It would mean people are paying more in taxes simply because the cost of living went up, not because they're actually better off financially. Alright folks, let's wrap things up with some key takeaways. First off, the IRS regularly adjusts tax brackets to keep pace with inflation, potentially lowering your tax burden. So keep an eye out for those adjustments each year. Secondly, understanding how tax brackets work is crucial for optimizing your tax strategy. Whether you're single, married, or head of household, knowing which bracket you fall into can help you make informed financial decisions. And lastly, don't forget about the standard deduction. It's a powerful tool for reducing your taxable income and saving money come tax time. So there you have it, folks. Everything you need to know about tax brackets and how they affect your bottom line. Thanks for tuning in. Like the video, and be sure to check out the link in the description for more information on tax filing services. Until next time, happy filing.